Alan, thanks a million for being part of this discussion. You know, I want to talk about the future, but in order to do that, I would like to kind of set the context of where we are today. You have written an awful lot about the causes of the financial crisis, and you've written also about evaluating some of the measures that were taken in response. I'd like to just go a little bit further and ask you if you could just ruminate a bit about the lasting effects. That if we were to look over the next couple of years, what would we be living with that derives from the financial crisis? You know, how has it changed the landscape? And I would include in that also the landscape about how we think about crises. You know, not only the landscape as it actually is on the ground, but sort of how it has changed the mindset of top officials and top scholars about thinking of financial crises themselves.
Yeah. A couple of quick points. First of all, I think maybe the biggest thing that it's changed in terms of the mindset here and in Europe is moving to it can happen here. We in the richer world have been watching financial crises in the less rich world for a long time and thinking nothing like that could happen to us. I can remember myself, I'm not immune to this fallacy, myself saying back in the 90s, when we in America were pushing less developed countries to open their capital markets, I can remember saying repeatedly that a country shouldn't adopt America's bad financial habits till it's rich enough to afford them. Well, it turned out I was only half right. That part is right, but we weren't rich enough to afford them either. I didn't know that back in the 90s. Of course, things weren't quite as bad back in the 90s as they got, but nonetheless, I think that I just take that as emblematic of an attitude that was prevalent in Europe, in the richer countries in Europe and the United States, which has been badly shattered, and especially here. After all, let's be clear about it. The biggest problem started here, and we infected Europe. Not that they were totally innocent, but this crisis was substantially made in America. The second thing I would mention is the traditional greed versus fear needle swung all the way to greed. And now it swung all the way to fear, and now it's starting to creep back towards greed again. I like it when it's closer to fear than greed, frankly. And the good news is it still is. For the most part, the financial system is still relatively cautious, but you can see the greed and the incaution creeping back. I noted in the newspapers just the other day, with shock actually, that some of the Wall Street firms are back to underwriting synthetic CDOs.
Right.
Well, boy, that's just what the country needs. I don't know how we've lived the last few years without synthetic CDOs. But so far, those instances look relatively isolated and small compared to the other problem, which is tremendous caution still. It's still hard to get a mortgage in the United States, even if you're pretty credit worthy, and that's sort of emblematic of the other side, and too bad. The third thing I would just tick off briefly without going into detail unless you want to, is the regulatory environment is in the process of substantial change. People don't quite understand the right tense to put on that. We passed the Dodd-Frank Act in America 3 years ago, more than 3 years ago. It's still being implemented. Many of the regs, the majority of the regs have not yet been written. And by and large, with some exceptions, Europe is running behind us. We're actually going faster than Europe. So a lot of this post-crisis reform of in regulation, and I might say in industrial structure, is still in the future rather than in the past.
Let me ask you one other question, just in terms of sort of lasting effects. Do you see a lasting effect on, let's say, the industrial structure of the U.S., and particularly the workforce, have we sustained a blow that is going to have a permanent scar, or is this something that basically we can't tell?
You mean sectorally or in the macro sense?
Well, in the macro sense, and we have high unemployment. A lot
Right.
of people saying it's a structural issue now.
Yeah.
Many of these jobs won't come back. Technology is very,
Right.
all those issues. I just wonder
Yeah.
whether you can trace
Yeah.
at least the acceleration of that to the financial crisis.
I trace some of the acceleration to the financial crisis only in the sense that it caused a whopping deep recession, and that accelerates things that were sort of teetering on the brink, like maybe this business is viable, maybe it's not. Whoosh, it's not viable anymore, and people lose their jobs. I'm very much opposed, hostile, I would say, to the view that you hear espoused in some quarters that because of this experience, or maybe for other reasons, a substantial share of Americans are permanently unemployable for structural reasons. One concrete version of that you hear is that, well, we're not going to be able to get the unemployment rate below 7 or 6.5% ever again. I think that's nonsense. It's been, unless we're going to deviate really dramatically from history, that kind of nonsense has been raised before and proven wrong. Every time we have a whopping big recession, so we had one in 73, 4, 5, we had another one in the early 80s, you hear these jeremiads that we're never going to get the unemployment rate below 7 or something like that. Lo and behold, in the Clinton boom, it went down to 3.9. In the George Bush, quote, boom, it didn't look like much of a boom, but even then it got down to 4.4 or something like that.
Okay.
So I'm very confident, though it won't come soon, that we'll see a 5 handle on the U.S. unemployment rate again, despite all this talk.
Well, I think that's significant coming from you, and also a lot of people ascribe a huge number of things to the financial crisis, and I think it's important not to overstate,
Absolutely.
what stemmed from that.
Absolutely.
So let's look ahead now, and I'd like to ask you to think about some of the fundamental trends that are likely to impact the global financial system, let's say over the next 5 to 10 years. These are just trends that you feel are quite basic, and I'll ask you subsequently what may blow them off course, what the big variables are. But if you were just to draw a line through a lot of the ups and downs, what do you see as the most important things happening in the global financial system, looking ahead?
Well, yeah, I'm not sure there's one thing, but one thing that comes to mind is there was for many years, and still is actually, this continued in a funny way through the crisis, a dual trend towards very large financial institutions here and in Europe and in Japan, and in China for that matter. And these are not perfectly coterminous, but they're related. And a trend towards universality in what these financial giants are doing. So Europe was into universal banking for a long time. A number of the big American banks prior to the crisis started looking a lot like universal banks. Not quite, but very much. And one of the unusual things that happened during the crisis is some of the giants got bigger. It was under distress, like the government was coming every few months to J.P. Morgan Chase and said, "Would you buy this? Would you buy that?" And so they made some very large acquisitions. The quote smaller competitors like Bear Stearns got gobbled up. I don't know if we want to call Lehman a smaller. It was pretty big. And now there's some rethinking of both of those. So is it the case that the American, let me stick to America for a moment, the American financial giants, all of whom are technically banks now, so Goldman Sachs and Morgan Stanley are banks. I like to call them binos, banks in name only, but legally they're banks. Are some of these financial giants too big? And should we be doing anything? We have some laws on the books, such as the Regal-Neal Act, that limits the fraction of deposits any one bank can have, and we sort of nodded and winked at it during the crisis because, you know, you don't want to stand on that when you need, say, J.P. Morgan to come in and buy more banking assets. Otherwise, it's going to be dead. But so there's questions about it starting to enforce that. There's questions about, like the Brown-Vitter suggestion now in the Congress to make a radical change in how big we allow banks to be. It's dubious that that's going to get anywhere now, but who knows what might happen down the line on, say, a weaker version of that. And then there's the question of universality, raised, for example, in America by the Volcker Rule. But just take that as an example. So that's one activity of banks, proprietary trading, that the Volcker Rule, which was enacted into law but still has not been promulgated, as you know, wants to pull out of banks. And that's going to require, as that happens, that will require some shrinkage, A, and B, a departure from universality. In England, you have ring fencing proposals, which may be adopted shortly by the Parliament. The last thing I would try to guess is the vagaries of British politics. I can't even guess the vagaries of American politics. Right. But it looks like something like that is probably going to pass Parliament soon. And in the EU, you have the report of the high-level experts group under the leadership of Erkki Liikanen, the governor of the Bank of Finland, that has a different way of hiving off some of the trading activity, different from Volcker. But I take these to be just examples of what may become more lasting trends in the backlash from the crisis. Now, it's a fair question to ask, is that an appropriate backlash? Were those the things that really got us into trouble? To me, it was much more of the blame went on bad incentives and very poor regulation than on the things that I've just been speaking about. Nonetheless, the whole apparatus of modern finance got badly tarred by, and deservingly so, by what happened in 2007, 8, 9.
Part of what you're talking about obviously involves regulation, but if you were to look at other areas in the regulatory system in terms of a trend, how would you think about, for example, the trend towards capital reserves, or the trend? Let's make it more general. The whole notion of bigger cushions for financial institutions, even if it means less profitability. Is this something we're going to see, or is it something that we just can't tell yet?
Well, to some extent we can tell, and the question is whether it's going to go further. So let's just start with banks, quote unquote, and Basel III. Basel III does raise the required capital cushions of banks, or anything that calls itself a bank. To me, more important than that, this is a personal judgment, is that it gets a lot fussier about what we're going to call capital. Frankly, under Basel I even, and under Basel II, there was a lot of mysterious, hokey capital. Lots of financial concoctions that got counted as capital. Sometimes it was Tier 2 capital instead of Tier 1 capital. Basel III, to its credit, puts the emphasis squarely on tangible common equity, what we economists like to call capital, real capital, not phony capital. And so while Basel III relative to Basel II raises the capital standard, it raises the tangible common equity standard by a multiple. Now, that said, there's an argument in academic and other circles that it's still way too low. That if you look at the degree of leverage, so let's just go say let's just define leverage for argument's sake as assets divided by tangible common equity, real capital. You can compute that for any institution, a car company, an electronics company. They all have leverage. And banking and finance in general stands out as operating with very high leverage. At the other extreme, you have most of the tech businesses. They got no leverage, basically. They operate completely with capital. That's their whole financing. And some of them make a lot of money. So I think it's a fair question to ask whether, A, the financial institutions need to operate with so much leverage, and B, couldn't they be profitable without it? Now, if you ask the bankers, you get a very unequivocal answer that requiring us to hold much more capital is really going to endanger our profitability. So I think this is one of the things that the United States and other countries, presumably you do this globally, are going to be debating for some time now. Another way to say it is I don't think we're going to sit pat with Basel III. Basel III left some problems, huge problems, unresolved, which is someday going to lead to Basel 4, 5, 6, whatever. I just mentioned two that amaze me. It still enshrines the rating of rating agencies and pivotal roles in defining how risky assets are. I can hardly believe that they did that. And the second thing I can hardly believe they did is they still allowed banks, as in Basel II, to use their own internal risk models to judge their own risk. I mean, when those two things came out of Basel III, I sort of shook my head in disbelief. So I don't think Basel III is the end of the story.
So let me ask you, in the context of these trends, what do you think about the expansion of the regulatory umbrella beyond commercial banks to the so-called shadow banking industry, or the shadow financial industry, whether it be hedge funds or private equity or money markets, or activities, like repos. If you were to bet 5 to 10 years, would the very definition of financial regulation be vastly expanded or not?
Yes, and let me take two of the things you ticked off as cases in point, and then take up the other two a little differently. The repo market, the tri-party repo market, is certainly coming in for more regulation. Exactly what's going to happen there, I don't know. But the Federal Reserve, and especially the New York Fed, is very worried about the potential fragility of that market. Second thing, which is happening already, money market mutual funds. As you know, they've been fighting tooth and nail against reporting net asset value on a day-to-day basis or anything else. And I think in the fullness of time, they're going to lose that bet. Because if you look around the financial landscape objectively and say, where is there a real vulnerability to runs? And, in some broad sense, the financial crisis was a series of, quote, bank runs, not literally, but figuratively. Money market mutual funds is standing right at the top of that list. It's huge and very runnable. And why should we be living in a world like that? The hedge funds and the private equity funds are a little different in the sense that hedge funds are now asked to do some minimal reporting of their assets, which wasn't really true before, and they didn't like. The way they're, quote, regulated now is that even a hedge fund could conceivably, if it grew large enough, like long-term capital management back in the late 90s, could be designated a SIFI, a systemically important financial institutions. None are now. And therefore come under the regulatory umbrella of SIFIs, particularly under the Federal Reserve. They don't want to do that. I think that's going to be a deterrent for any hedge fund ever growing that large. They'll just say, whoa, let's just stop here make sure we don't come under the SIFI umbrella. And that in itself, to me, is a very good thing. Because, from a systemic point of view, you don't worry about small or even medium-sized hedge funds going bust. This is not Lehman Brothers. This is not Bear Stearns. This is not Citigroup or something like that. If they're going to go bust, they should go bust. And the same is true of private equity companies. So though they're much, they have a different business. What they do is very different. They're not fundamentally trading businesses.
Again, in the context of looking ahead in terms of trends, do you think that economists, financial experts, will know a lot more about the financial system than they obviously did before? And I put it in this respect. Obviously, this is a system which is increasingly complex, increasingly interconnected, and just the very act of, let's say, understanding risk and measuring it is no small thing.
No.
So do you feel that the financial crisis has somehow been enough of a spur to the scholarly community and to other experts such that 10 years from now, at least the analytical basis, the ability to understand, let's say, how much risk, where the risk is, how it's shifting, how the most complex instruments work, will we be way ahead on that curve, or in fact, is this something that we're kind of destined always to be behind?
I think it's a mixture, but more the second than the first.
Okay.
I think already today, and it'll still be true 5 and 10 years ago, both academics and the regulatory community will be much more engaged in the details of finance than we were before. That's a good thing. But the industry is incredibly creative. It attracts an amazing amount of talent. And as in many industries, the profit is in innovation, thinking up something new, because things become, quote, just a commodity once everybody is doing them. And so there's a tremendous incentive in London and Wall Street and Singapore and Tokyo and Frankfurt and everywhere where high finance is practiced to think up new things. And the perversity of that kind of, you usually think of innovation and competition as a great thing, driver of progress. The perversity in the financial world, some things in the financial world work that way also. But the perversity in the financial world is a very major source of profits is befuddling your customers. So they don't know what they're buying. And we don't know, and we the regulator, I'm not a regulator, then the regulators don't quite know what they're selling and really have a hard time getting into the innards of the firm's balance sheet. And even if they do that, a lot of stuff is not really, it's either literally not on the balance sheet or figuratively not on the balance sheet. I'll give you an example of what I mean by the latter. Derivatives, when they originate, they start with zero, basically. It's neither an asset nor a liability. And then as prices move, they become an asset or a liability. But what you're after there is the exposure. What's the potential exposure? That's not what a balance sheet measures. So to me, sadly, it's basically inevitable that the regulators will be behind the market. Hopefully we won't fall as far behind as we did before. We may have learned that. I used to say, another one of my aphorisms when I was a regulator, I used to say our objective here at the Fed is to stay 2 steps behind the market. If we start falling 6, 8, 10 steps behind the market, we're in big trouble. But there's no way that the regulators can keep up with the pace of innovation in the markets.
And would you and how would you approach that very same question with regard to academic scholars, people who are doing research, at Princeton or Yale or any of these great places where they're really looking in a very micro way and also in a macro way in terms of how markets are behaving?
I'd say with a few exceptions. There are a small number of scholars at Princeton, at Yale, and everywhere that really dig down in the weeds. Most of these people, by the way, are consulting with financial companies, which is one of the ways they get into the weeds. But the vast majority are operating at a higher level. And until something gets big, it doesn't capture much attention. I mean, we saw that, for example, with subprime mortgages. I mean, how much academic work was there on subprime mortgages before it all blew up in our face? You know, we had a vague idea that there are such things. I'm pretty sure, I know I couldn't have answered the question, and I'm pretty sure most academics couldn't have answered the question in 2005, 6. What's the volume of outstanding subprime mortgages?
Yeah.
I wouldn't have known.
Right.
I don't think many academics knew. A very small number who were basically consulting for the companies sort of knew, but most didn't know. So I don't think, except via their consulting arrangements, the reward structure in academia doesn't point you towards, you know, the third degree of detail. You know, if you think of an outline, A1, little a, Roman 2, you know, by the time you get to Roman 3, there's no incentive in academia to go there.
Okay. So I want to now ask you about hypothetical. Let's say that you were asked to be a commission of one, and to
Best kind of commission. No, I'm kidding.
Design the global financial system for, let's say, a decade from now. And the question was, what features would you like it to have that it doesn't quite have today? In other words, in what areas could it be strengthened, and what difference would that make? And I'd like to just start, if I were asking this question to a lot of people, I think they might start by saying, we need stronger rules for managing currencies, or we need some rules that relate to the global imbalances. So I'd like to just use that as a jumping off point, and then kind of get your take on that and the rest.
Okay, well, let me start by saying where you just finished, Jeff, is way down my list. I don't think that's a high priority at all.
Okay.
And in fact, I've for a long time believed that, with some exceptions, there are always room for exceptions, floating exchange rates are better than fixed exchange rates. They're less vulnerable to speculative attacks and things like that. And they give you a kind of a gradual adjustment to imbalances instead of sudden adjustments to imbalances. And we've seen time and again in the developing world that pegging either literally or figuratively your currency to the dollar, it's generally the dollar, leads to disaster. So I understand there may be reasons for exceptions, but so part of my answer to your question, I would say, is more floating, less fixity in exchange rates. Second, I would say we want to have open global capital markets, but not too open. This comes back to what I was saying before, that you want to bring around the less developed countries, and in this respect, by the way, China is still a less developed country, gradually into this complicated, interlocked world financial system. So I can, as I look into the far, far future, I'm not sure what that means, 25 years, I think probably dealing in Chinese financial assets should look a lot like dealing in Japanese financial assets now, but not tomorrow, not next year, not 2 years from now. And that's China, which is relatively far along, and you've got lots of countries trundling along behind China that shouldn't be entering the Wild West, let's put it, too quickly. That was a point I made earlier, looking back, but it still holds looking forward. And thirdly, on my wish list, but this may be a vain wish that's never going to happen, would be greater harmonization of financial regulation around the world. I'll give you two concrete examples that are very important, but there are many others. One is bankruptcy codes. We saw this dramatically with Lehman, but that was only the most dramatic example. When a multinational company, a financial company especially, goes bankrupt, and the bankruptcy provisions, and by the way, with bankruptcy, I would also include resolution under an authority like we do with the FDIC.
Okay.
That's not a bankruptcy literally, so I mean bankruptcy or resolution. When the regimes, the legal regimes governing that are radically different from between country A, B, C, D, it's a terrible mess, and potential disaster. And it would be nice to harmonize those. I don't harbor any illusions that we're going to get there anytime soon. Look, I mean, Basel 1, 2, 3 had that same kind of origin. The big bankers and the big bank regulators got together and said, you know, we got to try to harmonize the capital regime around the world. And that sort of succeeded with a lot of lumps and bumps. But we're eons away from doing that with bankruptcy and resolution. A second example of that, which is a pet peeve of mine, and has been illustrated by several brouhahas in recent months, is regulation of derivatives, where you have just radical differences in opinion, first within countries, but then across countries. So you saw, for example, Gary Gensler, the head of the CFTC, trying to get pretty far out front of the norm on regulating derivatives, getting tremendous pushback from his own commission,
right,
from U.S. Treasury, and then, because it's international, from foreign countries very resentful that the United States was trying to tell other countries what they should be doing, only in the sense that they were our banks operating in, say, in London or Frankfurt or wherever they were, and the CFTC wanted to extend its regulatory reach there. So that's very much up in the air, and is just a second example of the difficulty of harmonization. But I hold up Basel to show that it's not completely impossible. I think probably people in the mid-'80s, before Basel I, many people would have said, this is impossible. You're never going to get Japan and Europe and the United States to agree on a common standard, but sort of we did.
How would you approach this same issue, you know, the kind of idealized global financial system 10 years or so from now, when it comes to the conduct of central banking? How I mean, there's been, as you have written so eloquently, there's been a lot of experimentation, there's been a lot of movement on almost, you know, unprecedented ground, but taking away the evaluation of what's happening right now, 10 years from now, what would you like to see about central banking that might not exist today?
Okay, so let me just mention two things briefly. Two things that have changed a lot in recent years, one of which I'm pretty sure is not going back, and the other is the big question whether it is going back. So the first is much greater central bank talk. The term of art that's being used mostly these days is forward guidance. What does that mean? That means central banks actually talking pretty explicitly, sometimes they're a little cryptic, but pretty explicitly about their own plans for the future. These days, it's when are we likely to raise rates and under what circumstances. In some future day, it may be when are we likely to cut rates and under what circumstances. But the generic is much more communication. This trend has been going on for more than 20 years now. It was accelerated by the crisis, as it should have been. I think that was appropriate. And I don't think there's any going back. So I think that's a permanent change in the way central banking is done, is now done and will be done around the world. The bigger question mark are what are called unconventional monetary policies other than forward guidance. So in the United States, this is largely QE, quantitative easing, but it can take other forms than that. What I basically mean by unconventional monetary policy is monetary policy instruments that work somehow in the financial markets but are not about changing the overnight interest rate.
Right.
So they've been forced on a number of central banks by the zero lower bound on nominal interest rates. So you put your short-term overnight rate down to zero nominal. That's about all. That weapon is now gone. That's the conventional. That had become the conventional monetary policy instrument around the world. And many central banks became unable to use it any longer, and so they turned to some of these unconventional. There are two very diametrically opposed schools of thought on this, and I don't know how it's going to shake out. What the Fed does, by the way, will be very important, because I know this sounds chauvinistic, but the Fed is still the exemplar and the first among equals in global central banks. The controversy is whether we go back, as things normalize, to the old way. So the only thing the Fed does is change the federal funds rate up or down. That's it. That's the way it was when I was vice chairman of the Fed. That's all we ever talked about, is what we can do with the federal funds rate. Or will some of these unconventional weapons become permanent parts of the central bank's arsenal? So let me just be a little more concrete about that. Several things the Fed has done in the last several years have been about changing the slope, generally flattening but lately steepening, of the yield curve. So the quintessential example of this was Operation Twist, right, in which the Fed is buying longs and selling shorts. But the thrust of most QE that the Fed has done has been to buy long-term government bonds, much longer than it used to try to flatten the yield curve. Now, as the Fed exits, it's actually deliberately steepening the yield curve, which I find a little bit peculiar, frankly. But leaving that aside, the generic question is, will central banks around the world adopt policies that either change the slope of the yield curve or change risk spreads between private assets and government? So QE2 and QE3 have had the Fed buy, QE1 and QE3 have had the Fed buying mortgage-backed securities to deliberately try to shrink the spread between mortgage-backed securities and treasuries. Those two things are mostly what unconventional monetary policy has been about, and the question is, will that all disappear as the financial system normalizes, or will central banks stay with the program? So, I don't know how that's going to come out.
From a global standpoint, if central banks pursued the course of continuing having unconventional policies as part of their arsenal, and that they are, let's say, more inclined to use those policies at various times, does this have an implication for the interrelationship of central banks? Because certainly a feature of our system, as far as I can see, is that they have been the collaboration has been pretty good among central banks. So we don't have central banks that are sort of fighting or who are oblivious to one another's actions. Might not be total harmony, but then that's controversial too, whether, it could be. But does this have an implication for, let's say, the global system of central banks if they were to depart from just focusing on overnight interest rates?
Oh, I think it does. First of all, you have plenty of potential conflict, and sometimes there comes actual conflict. I mean, they don't fight with each other. It's a gentleman's it's actually mostly a gentleman's club. Some women are allowed in. They don't have knockdown dragouts as you see in the political world, but you do see central banks pursuing inconsistent policies. That's not a criticism, because what's good for country A might not be good for country B. And anytime there's a modest to large movement in short-term interest rate differentials across the globe, capital flows.
Right.
If you add also that they're going to be fooling around with risk spreads and or the slope of the yield curve, you've had two more dimensions in which differences across central banks can lead to potentially sizable capital flows.
Okay. Final question. You look ahead the next decade in the global financial arena. On balance, are you optimistic that the system is going to become much stronger, let's say, more proportionate to its size and complexity, or are you on the side of people who are really concerned that basically this is a kind of unruly tiger, and that what we saw in 2008 will inevitably be repeated with even more damage, not because anyone's venal, but simply because it may not be within our capacity to control the system? Where do you come out on that?
I'm a little closer to the second than the first, but with a big caveat. We saw literally the 70-year flood in 2008. I don't expect to see another one like that for a long time. But we've seen 5-year floods, 10-year floods, 1-year floods, 15-year floods repeatedly in the 20th century. Unless we maintain a level of regulatory vigilance that I find very unlikely once the good times start rolling again, we will have repetitive crises. Again, I don't expect in the next 30, 40, 50 years to have something that looks like 2008. But you can do a lot of damage with crises that are smaller. And I might add less global. I mean, I'm talking about that, but the Southeast Asian crisis in 97-8 did more damage to that region than the 2008 did to that region.
Right. Yeah, good
so
point.
You can have regional catastrophes. The amazing thing about 2008 was, in addition to its size, how global it turned out to be.
Alan, thank you very much. That was really a very, very interesting tour of a lot of very important issues. So I really appreciate it.
You're very welcome, Jeff.